What's up YouTube? If you're new here, welcome. My name's Justin Nguyen. On this channel, I share my thoughts about the stock market, stock research, and different stocks that I'm buying personally or am looking to buy. Feel free to follow me on Instagram and make sure that you subscribe to keep up with all the future content that I'll be releasing. And for my current subscribers, don't forget to hit that like button to help me grow this channel so I can keep putting out content that is free for you. A little act of kindness like that really goes a long way as it helps me beat the YouTube algorithm. So I bought a new stock recently and I have not yet mentioned it on this channel. Make sure you watch this video all the way through so that you get my full bull thesis as to why I think this is a great company to buy as a long-term play. And remember, this is not financial advice. Everything that I share is for entertainment purposes only, and you shouldn't buy a stock simply because I'm buying one. Make sure you do your own due diligence before you make any investment decision. All right, so the stock that I'm buying, it is a long-term growth play. This is one of those companies that you cannot just buy and hold for a short period of time, like a few months. You have to be willing to hold this company for at least a few years. The reason this is a long-term play is because this company is still in its early stages of growth and expansion. This company won't see profitability for a few years, and so you have to be willing to wait until you can start seeing positive cash flow and when the net income is in the green. And that's when investors will reap the big juicy gains. Getting in this company early is going to benefit those investors who are willing to wait and be patient. I've done a lot of research on this company and I'm really liking what I'm seeing, and so I started a position just recently. All right, so the company that I just bought is GameStop. Ticker symbol GME. So the reason I like this company a whole lot is because some of you were gullible enough to think I was serious. All right, for real, I just bought Teladoc Health, ticker symbol TDOC. I currently own 8 shares with a cost basis of $189.74. At the time of this recording, Teladoc is trading at $193.74. It's fallen over 30% from its all-time highs. Even though this stock has fallen that much in the short term, it would be important to know that even with a 30% trim, it is still trading extremely rich when you look at it from a valuation standpoint. Later in this video, I'll share about my personal buying strategy when it comes to Teladoc. For those of you guys who are not familiar with the concept of telehealth, it is simply virtual healthcare. So imagine, instead of scheduling an appointment with your local doctor and having to drive to their practice to become evaluated, with Teladoc, all you have to do is download the app. And from there, you just input your information and you can schedule an appointment and be on a virtual video call immediately. This company gives you an opportunity to have access to a doctor or a specialist at the touch of a button. Telehealth has lots of benefits over local providers of healthcare. The first benefit is convenience. Having access to a doctor or a specialist whenever you need them is so nice. As it says on their website, whether your child wakes up with a fever at 2 a.m. or you've just received a serious diagnosis, we're here. Not only is Teladoc very accessible, it's also very comprehensive in all of the things that it has to offer. Teladoc Health is known to be the global leader in comprehensive virtual care. This company is not a one-trick pony. It's not like this is the go-to place if you need someone to talk to if you have the flu. It's actually able to provide for all types of different problems and meet all sorts of people's needs. All sorts of needs, from acute pain to chronic issues to more severe and serious problems that you may be experiencing and facing, to mental health, to diabetes, weight loss. They offer so many different services. As you can see in their investor presentation, they brag about being a trusted destination for whole person health, with all of these different examples here. My doctor told me to get me surgery. Do I need it? My blood pressure is out of control. I need help. I need help managing my stress and anxiety. I want to easily connect with my doctor online. I have to lose weight and have more energy. I have a fever of 101.3. I need a referral to a cardiologist. They offer so many different options depending on where you're at. So overall, Teladoc is very convenient because it's so accessible and comprehensive in its care for its clients. The second benefit that Teladoc Health has over local providers is that it's cost efficient. Telehealth is generally cheaper than in-person visits, creating more incentive for people to seek treatment and for employers to provide virtual care under their healthcare plans. So not only is it cost efficient not going into the doctor's physical office location, most people don't like going there anyways. And so they can stay at home at the comforts of their bed or wherever and just be able to talk to their doctor from there. And the last benefit to Teladoc Health over local providers is that you can have access to some of the best doctors and specialists globally because it's through video. And so your online doctor may actually be more proficient and skillful than your local provider. Obviously, with the pandemic, this industry has blown up because people realize how much better telehealth is. Some of you watching may be like, I never knew this existed. And so you're gonna say bye to your local provider and join Teladoc after this video. So here's a question. If Teladoc Health is such a great company in a booming industry, why is it declining? Well, the reason why Teladoc Health is dropping is really 3 reasons. The first reason I'll show you by using a meme. Amazon has grabbed the attention of many investors because they are expanding aggressively into the telehealth space. Just a few days ago, Amazon confirmed that they're going to expand nationwide for their telehealth services. Because Amazon is such a powerhouse, investors are spooked that they're going to absolutely take over. Some people have actually gone as far as to say Teladoc is done for. And honestly, I think that's so blown out of proportion and ridiculous, and I'll share in a bit why. The second reason why this stock has been plummeting so much over the last few weeks is because they were trading at such high valuations and their income statement in this past earnings report was horrendous. Investors were planning that Teladoc was going to take over the entire telehealth industry, and so the price was just going up, up, and up. But that was so foolish to think, because every opportunity where there can be a lot of money made, there's gonna be competitors who enter in and want to get in on the game. It kind of reminds me of the gold rush when all these people were moving west because there was opportunity to make a lot of money. And in the same way, Amazon saw telehealth as the gold mine that they should enter into because it's so profitable. So the valuations were so high, but also the numbers look really bad on paper. In the last year, Teladoc recorded a huge net loss of $485 million. In the previous year, it was only $98 million. Some investors just simply looked at the numbers and were like, the financials are horrible, we're out. The reason why Teladoc recorded such a massive net loss, almost 5 times compared to the previous year, is because they made this huge acquisition. Teladoc acquired this company called Livongo, and it costed $18.5 billion. And to be honest, people jumped ship because they saw these 2 things: high valuations and a horrible net loss, and they were like, I'm out. And the third reason why Teladoc has fallen so hard is because their guidance has fallen. They reported that they're not going to be expecting the same levels of growth that they saw in 2020 during the pandemic while everyone was at home. So let me address these 3 catalysts as to why Teladoc was falling and why I think the sell-off was well overblown and provides a great buying opportunity for long investors like myself. So the first catalyst is that people were scared that Amazon was entering into the space. I understand the concern. Amazon is a big dog, but honestly, I'm not too concerned. And here's why. The fact that Amazon is spending so much money, time, and effort into expanding their telehealth arm of their business shows me and is proof that this industry of telehealth is extremely profitable and worth it. Just because Amazon is now in the telehealth space and expanding rapidly, it doesn't mean that there's only space for just one player. This isn't a game of King of the Hill where there's only going to be one reigning company. There's actually enough room for both of these companies, Amazon and Teladoc, to take over the entire space. The total available market for the telehealth industry is well over $100 billion. And did you know that Teladoc only has less than 1% of that entire opportunity? In Teladoc's investor presentation, they said that the opportunity is $250 billion. Here's a funny way to think about what's going on. Imagine if Teladoc was like a little kid swimming in a little inflatable pool, and Amazon was this big fat kid running around and about to jump into the pool. I would be freaked out because there's not enough space for the 2 of them. Now imagine that little kid, which represents Teladoc, is swimming in the Caspian Sea, which is the largest sea in the entire world. And you get Amazon, the fat kid, running, about to jump into the sea. You wouldn't freak out because there's so much space for the both of them to play and enjoy. If you think that the virtual care market opportunity is a small little pool that only one person can fit in, of course I would be scared that Amazon is joining the party. But because this is actually such a massive opportunity, if Teladoc and Amazon is going to infiltrate into that industry, I'm not worried because there's so much opportunity and space for both of them to thrive. And another reason why I'm not scared of Amazon's presence is because Teladoc has already been in this space for many years, and so they know it very well, and they're the market leader. Let me give you an example of this happening. So think of Tesla when it was only at a $40 billion market cap just a year and a half ago. And they were the leading player when it comes to electric vehicles. And people got scared. Investors were worried whenever these big car manufacturers said, hey, we're going to create our EV vehicles too. The problem is Tesla was already the market leader, and they've been in the industry for so long that they knew it so well, and their tech was so much more advanced than all of these other competitors, even though these competitors were bigger and had more money. Same is true with Teladoc. They've been in the industry longer than Amazon has, and they have much better coverage and service for their clients that I'm not worried about Amazon taking over their clientele or anything like that. Man, this happens so many times with companies and businesses, and honestly, people get freaked out for no reason. There's other times in history when it was like Netflix was being disrupted when Disney Plus came out, or when Google introduced their very own social media platform, Google Plus, when Facebook was innovating and growing. And the reality is the big dogs that tried to disrupt the person who was already in the industry, they didn't really succeed. And so Amazon, I think that they're going to make it. They're going to get a lot of clientele, but they're not going to be able to dominate Teladoc like some people are saying. And so the other big concern that investors have with Teladoc is its future growth. Investors are worried because this parabolic growth that Teladoc has seen in this past year is not sustainable. Duh, parabolic growth is not sustainable. Something happened last year that I think is much more important. And that's that the pandemic normalized Zoom and video call meetings. If you asked someone to hop on a Zoom call with you back in January of 2020, they would have felt very uncomfortable. But if someone asks you to hop on a Zoom now, it's like, yeah, sure. According to some research, 79% of people have said that scheduling a follow-up visit using telemedicine was more convenient than doing so in person. And 83% of patients expect to use telemedicine after the pandemic. So because telehealth was normalized during the pandemic, that's going to make it easy to have consistent and stable growth over the next decade. So do I agree that we're not going to continue to see parabolic growth? Yeah, but I think we're going to see consistent growth over the next few years. So not only have the studies shown that people actually enjoy and prefer telehealth, and they plan on doing it after the pandemic, the retention for Teladoc is insane. A lot of Teladoc's clients stick with the company. They have over 90% client retention. So when I look at this company over the next 3 to 5 years, I definitely see consistent, stable growth as well as high retention because people are just going to prefer using telehealth over driving to their local provider to get care. Honestly, Teladoc just provides a better method of how we should be doing healthcare in the future. And with this company's recent acquisition with Livongo, I think this company is going to increase in growth dramatically over the next few years. Even though they're spending a lot of money in the short term, they're spending money to make more money, and I'm okay with that as a long-term investor. Other things I like about this company is they have really good profit margins as well. I think it would be helpful for me to show you the graph of this company's growth. Teladoc shows a consistent track record of robust growth. Even before the pandemic, we were seeing high levels of growth. As it says here, over 70% compound annual growth rate and over 80% reoccurring revenue. Their visits and paid memberships have been increasing with 40% compound annual growth rate for paid memberships and over 80% compound annual growth rate for new visits. And I know some of the bears out there are probably thinking, I don't like this company because the revenues are so attached to their subscriptions and they're absolutely dependent upon it. Well, even though it's true that a majority of their profits come from their subscriptions, this company is planning on increasing their different revenue models to make a profit. As you can see here, they plan on having more members, more products, more utilization, and expanded revenue models. And so to wrap up my analysis on this company, I'm not worried about the short-term headwinds that Teladoc Health is facing. So this company is positioned for insane amounts of growth over the next 5 to 10 years. With this recent acquisition, I think they're going to have a lot more people who are interested in their services. And remember, they're so comprehensive in all the different things that they provide. And I think when people try out Teladoc, they're going to stick with it, as we can see with the retention rates. And this company is overall top quality. they've really created a better model for something essential like healthcare. And for that reason, I'm happy to be an investor in this company. So real quick, here's my buying plan when it comes to Teladoc. Currently, it's sitting under $30 billion in its market cap. And honestly, anything under $30 billion is a good price and a good entry point for a long-term position. However, this company continues to show weakness in the short term, which I kind of hope it does. I'll add more to my position. When I look at the potential of this company, I can easily see it hitting a $50 billion market cap over the next few years, which gives it a lot of room to run. I always like to compare my analysis with other investment research groups out there. When I look at Morningstar, they give Teladoc a fair value of $225. In my opinion, that's pretty high, but I definitely see this company hitting that price in the future. And because they gave it that price target, they give it a 3-star buy rating. And so there you have it. That's a company that I've been buying recently, and I'm looking to continue to add to my position if it shows weakness in the short term. Also, if you've watched this video all the way through to this point right here, I just want to say I see you and I appreciate you guys so much. Thank you so much for tuning in and watching this channel, and I hope I can continue to give you good content in the future. So make sure you hit that subscribe button. If you haven't yet, hit the like button, turn on the notification bell, all that kind of stuff to stay up to date with all things to come. Well, I'll catch you next time, so go make that money.